Welcome to the deep dive. Today, our mission is to really get into the weeds, cut through some of the noise surrounding the natural rubber industry.
Yeah, it's a fascinating sector.
Yeah,
And pretty volatile right now.
exactly. We've got two major players here, both based in Thailand. Sri Trang Agro Industry, that's STA, and Northeast Rubber, or NER. And we're basically putting them head to head, trying to figure out which one looks like the more compelling investment, right now.
And it's a really interesting time for this comparison. I mean, it's high stakes. Both STA and NER, they're swimming in the same pool, right? Exposed to the same global commodity prices.
Which have been turbulent, to say the least.
Brutal, yeah. They sell pretty much the same basic stuff. But, and this is the kicker, their latest results from Q2 2025.
Yeah.
Worlds apart. I mean, shocking divergence. One company posts really strong profits, the other a massive net loss.
And that's the core puzzle, isn't it? That divergence. That's what we need to solve today. We're not just going to look at stock charts.
No, got to go deeper.
We need to peel back the layers, look at their fundamental financial health. We'll be stacking up the key metrics, PE ratios, dividend yields, debt to equity.
The classics.
Right. And compare those against how they actually performed operationally in Q2. See which one really shows more resilience, maybe more long-term potential for, the curious investor out there.
And you mentioned turbulence. That Q2 performance didn't just happen in a vacuum. The whole macro environment has been, punishing.
You're talking about the U.S. tariffs.
That's a big part of it. The shockwaves from the U.S. reciprocal tariff announcement sent ripples through the entire supply chain. Combine that trade uncertainty with rubber prices just swinging wildly.
A rubber wintering phenomenon.
Yeah, exactly. Sometimes it's seasonal, sometimes it's driven by events like these tariffs. It really pushes companies to their limits. Q2 is like a perfect stress test. It really shows you which company has that underlying financial muscle, that managerial resilience.
Okay, great setup. Let's unpack this then. First up, maybe just paint a picture of who these companies are, their basic identity and strategy. Let's start with the bigger one, STA, Sri Trang Agro Industry. They build themselves as this integrated giant. Reading their materials, that whole integrated model seems absolutely central to, everything about them. Their risks, their potential rewards.
It absolutely is. Their whole corporate identity is wrapped up in this phrase, the world's leading fully integrated green rubber company.
Right.
What that actually means in practice is they control way more of the supply chain than, say, NER does.
Yeah.
They're involved from the upstream, sourcing the raw rubber, all the way through to specialized manufacturing downstream.
So more control, but maybe more complexity.
Definitely more complexity. And it leads to a pretty diverse revenue mix. I mean, the core natural rubber products, things like TSR, RSS, latex, that's still the lion's share. About 80.6% of their revenue in Q2 25.
Okay, so still mostly rubber.
Mostly. But they also have this other very significant, very specialized vertical business.
Ugh, the rubber gloves. That's been a wild ride for them, hasn't it? Pandemic boom and the bust.
Exactly. That glove segment, STGT, it can be hugely profitable when the cycle's up, but it brings in totally different market dynamics, separate from just the raw commodity price. In Q2 25, gloves brought in almost 6 billion Thai baht.
Which is nearly a fifth of their total sales.
Yeah, 19.4% of the top line. So their strategy, fundamentally, it's long-term. It's built around achieving massive scale. They're constantly expanding capacity. Look at the numbers. Installed capacity went from 2.82 million tons in 2024 up to 3.72 million tons by mid-2025. And they're aiming for 4 million tons by 2029. That's aggressive.
Wow, that sounds incredibly capital intensive. I mean, that's a huge bet on global rubber demand just continuing to climb steadily for years.
That's definitely the calculation they're making. They want to have the scale not just to grab market share now, but to basically dictate terms later as global demand grows. And tied right into that scale strategy is this big push on sustainability.
The green rubber thing.
Right. They see it as a future competitive edge. And it's not just talk. They've got tangible investments like over 32 megawatts of solar power installed. And crucially, they're really pushing hard on compliance with the new EU deforestation regulation, the EUDR.
That EUDR, that's going to be a massive deal for anyone exporting to Europe.
Right.
Affecting lots of commodities.
It's huge. It's a major hurdle coming down the track, and it's going to create a real competitive moat for those who comply. You need full traceability, proof that your rubber didn't come from recently deforested land.
And STA is already moving on this.
Aggressively. They sold over 52,000 tons of EUDR-compliant rubber just in Q2 25. They're taking the pain now, the cost, the complexity, because they believe It secures long-term market access, maybe even a price premium down the line.
Okay, so that's STA, integrated, massive scale, betting on long-term growth and sustainability compliance. Now let's pivot to NER, Northeast Rubber. If STA is the giant, NER seems, well, different, more focused.
The contrast is really sharp, yeah. NER is laser-focused. They do core rubber products. Block rubber, mixed rubber, smoke sheets, high-volume manufacturing, efficient distribution. That's their game.
So they deliberately avoid things like gloves.
Exactly. They stay away from those high volatility, high investment downstream bits, their main customers. Automotive industry, intermediaries. Keep it simple, keep it efficient.
And looking at the Q2 numbers, that focused model seems to have served them really well, even when the market was, tanking for STA.
It really speaks volumes about their efficiency, their throughput. While STA was wrestling with inventory values, NER actually grew its sales volume significantly, up almost 24% year over year in Q2.
24% volume growth in that market.
Yep, hit nearly 112,000 tons sold. And that volume growth directly drove their revenue. Total revenue was up over 30% year over year, reaching about 7.6 billion Thai baht. Their strategy isn't about integration. It's about maximizing the efficiency of their core production, just churning it out.
Interesting. And geographically, I see they're mostly domestic, but international is growing faster.
Yeah, that's right. Their stability comes from that strong home base in Thailand that's about 80% of their sales, and it grew a solid 29% year over year. But the real excitement, the growth engine, is international. That's only 20% of sales, but it grew almost 37% year over year.
So they're expanding globally too.
They are. And like STA, they're also getting ready for the EUDR. They prepared something like 65,000 ray of compliant cultivation area, aiming for 120,000. So they see the writing on the wall too.
Okay.
But the fundamental difference is clear. NER is optimized for efficient processing, speed, throughput. STA is built for integration, scale, controlling the whole value chain.
That focus you mentioned on SDA's massive capital spending, aiming for 4 million tons, it immediately makes me think about risk. How do they finance that? How do they manage the financial side? Which brings us neatly to the core financials. Right, let's get down to the nuts and bolts. Valuation, income, safety. Starting with the PE ratio, price to earnings, the classic valuation metric. Looking at the numbers, this one seems like a clear win for NER, doesn't it?
Unambiguously, yes. At least if you're focusing on current actual earnings, NER's latest PE ratio based on the last 12 months is just, it's incredibly attractive at only 4.34 times.
4.34, that's really low.
It is. Their earnings per share is 0.98 Thai baht. A PE that low suggests, either the market thinks their growth prospects are minimal, or maybe it's just seriously undervaluing their consistency right now.
So potentially cheap.
Potentially very cheap. Even looking ahead, analyst forecasts for 2027 put the PE a bit higher, maybe 5.06x, but that's still remarkably inexpensive for a company that just delivered double-digit profit growth year over year.
Definitely looks like an earnings bargain on paper. But how do we compare that to STA? They posted that huge loss in Q2. You can't really have a PE ratio then, can you?
Exactly right. That's where you need to pivot, especially in cyclical industries like rubber. With STA showing a significant loss, the standard PE becomes meaningless, temporarily anyway. So analysts and investors, they look at price to book value instead. PBV.
Okay, PBV.
And STA currently trades at a PBV of 0.64 times.
0.64 times book. Can you just quickly break that down for listeners? What does that actually signify?
Sure. So book value is basically the theoretical value of everything the company owns its assets, like cash, factories, land, inventory, minus everything it owes its liabilities. If the stock trades at 0.64 times book value, it means you're essentially buying the company's underlying net assets for 64 cents on the dollar.
So you're buying the physical stuff, the factories, the land, at a deep discount to what it's theoretically worth on paper.
Precisely. It's an asset-based valuation.
Okay, so the valuation story is really split then. NER is cheap based on its earnings right now, PE of 4.34. STA is cheap based on its assets, PBV of 0.64 because its earnings took that temporary hit.
That sums up the current valuation tension perfectly. One's an earnings play, the other's more of an asset or turnaround play.
Got it. Okay, metric number 2, income, dividend yield. Commodity companies often pay decent dividends, right? Because they're seen as cash generators, maybe not massive growth stories.
That's generally true, yeah. They return cash to shareholders. And here again, NER looks very appealing.
High yield.
Very high. Quite specific in the data we have. NER's reported annual dividend yield is currently 8.49%.
Wow, nearly 8.5%.
Yeah, and their payout ratio in 2024 was just over 40%, which seems sustainable, and shows management is committed to returning cash. Analysts actually seem pretty bullish here too, forecasting that yield might even climb towards 9.3% by 2027, assuming profits keep growing.
Okay, very attractive for income seekers. What about STA? Despite the loss, are they still paying out?
Well, analyst expectations are still factoring in a pretty decent yield for STA. The consensus seems to be around 7% per year, sort of a sustainable level. They did manage to pay out 0.31 Thai baht per share based on their 2024 results, before this recent loss.
So 7% expected versus NER's current 8.5%.
Right, so both are pretty attractive on the income front, definitely higher than the broader market, but NER currently has that slight edge based on the latest reported numbers.
Okay, yield is important, but in cyclical industries, maybe safety is even more crucial. Which brings us to metric number 3, debt to equity, DE ratio. How much leverage are they using? How big is their financial cushion?
And this is where the story flips completely. This is where STA really shines and demonstrates its foundational strength.
Okay.
For a company dealing with volatile commodity prices, a low DE isn't just nice to have, it's almost essential. Your cash flow can be unpredictable. And STA, their net debt to equity ratio is exceptionally low. As of Q2 2025, it stood at just 0.54 times.
Wait, 0.54? Did I hear that right? That's incredibly conservative. That's less than 1 part debt for every 2 parts equity. And I see that number actually improved. It was 0.77x at the end of last year.
It did improve. It's really a testament to some pretty disciplined financial management. They were actively using cash flow, even during that tough rubber wintering period, to pay down short-term debt.
So they were strengthening the balance sheet even as the market got tougher.
Exactly. And that low DE gives them enormous flexibility. They can withstand market shocks like the one they just had. They could fund acquisitions or expansions without putting the company at risk.
Yeah.
And look at their liquidity too. Their current ratio, measuring short-term assets versus liabilities, is 2.56 times. That's way up from 1.62x. It's basically a fortress balance sheet.
It's honestly kind of astonishing. A company takes a hit of, 786 million baht loss in a quarter and still has a DE ratio that low. That level of financial strength really stands out. Now, how does NER compare on leverage?
NER operates with quite a bit more leverage. Analyst quotes put their DE ratio at 1.17 times.
Okay, so more than double STA's ratio.
Yeah, and their Q2 balance sheet backs that up. Total liabilities were around 10.9 billion baht against equity of about 9.1 billion baht. Now, 1.17x isn't necessarily sky high or dangerous in itself.
But in this industry,
with that inherent commodity price volatility, it just means they have a much smaller cushion, a smaller margin for error compared to STA's rock-solid position.
Okay, so summing up this section, NER wins clearly on current valuation based on earnings, PE 4.34x, and current income, yield 8.49%. But STA wins hands down on financial safety and balance sheet strength, DE 0.54x, plus that asset discount, PVV 0.64x. This perfectly sets up the next question. Why the huge difference in Q2 performance? Let's try and unravel that central mystery then. Why did these two companies, fundamentally selling the same stuff, have such wildly different Q2 results? Let's start with NER, the picture of stability, somehow managing growth despite all those headwinds.
NER's performance in Q2 really was remarkable in its stability. Their bottom line net profit came in strong at 554 million Thai baht. That's up nearly 16% compared to Q2 last year.
16% profit growth in that environment.
Yeah, and if you look at the first half of 2025 overall, their net profit was even better. 1.16 billion baht, up almost 25% year over year. So consistent growth, but we need to look a little closer than just the bottom line.
Because if the market was so choppy with tariffs and price swings, surely their actual core business, the margin on selling rubber, must have been squeezed.
Oh, it was. Severely squeezed. If you look at their gross profit margin, it definitely took a hit. It fell from about 12% in Q2 last year down to 10.6% in Q2 this year.
Okay, so the core profitability did shrink.
It did. That confirms they were hit by rising input costs. Their cost of goods sold actually went up faster than their sales revenue grew. CUGS up 33.4%, sales up 30.6%. So yes, the underlying business felt the pressure.
Okay, so if their gross margin was shrinking, how on earth did they still manage to grow the net profit by almost 16%? There must be something else going on lower down the income statement.
Absolutely. And this is where NER's, let's call it, financial sophistication really came into play this quarter. They essentially offset that operational turbulence with smart risk management.
Oh, so?
Two key areas. First, foreign exchange. They actually reported a gain of 37.25 million baht from favorable FX rate movements. But maybe even more importantly, they book another gain of 27.37 million baits, specifically from derivative instruments.
Derivatives, so hedging.
Exactly.
Yeah.
Hedging. Think of it like insurance for their prices or currency exposure. When you're selling commodities globally, prices and exchange rates jump around. Derivatives let NER lock in prices or protect against currency swings.
So when the rubber price plunged after the tariff news,
Their hedges likely paid off, acting as a buffer, protecting their bottom line even when the physical margin on selling rubber was getting hammered. Shows really effective financial engineering. They managed the risk brilliantly.
so it wasn't just operational efficiency, it was financial savvy protecting the profit. That makes sense. And the analyst outlook seems to reflect that confidence, right? They expect NER to keep performing well.
Yeah, analysts seem pretty positive. They're forecasting continued strength, maybe a normalized profit of over $2 billion bought for the full year 2027. They expect sales volume and maybe pricing to improve in the second half of the year.
No.
It paints a picture of consistent execution.
Okay, a story of stability through efficiency and hedging at NER. Now, let's contrast that with STA, the integrated giant. How did those same market forces lead to such a disastrous Q2 for them?
The numbers for STA are just staggering is the right word. A net loss attributable to shareholders of 786.8 million Thai baht in just 3 months.
787 million baht loss. That's a huge reversal from the profit they made the previous quarter and the profit from the same quarter last year.
It's a massive swing, down over 214% compared to Q1 25 and down 225% compared to Q2 24. Just to put that in perspective for listeners, that's roughly equivalent to a loss of about 22 million US dollars in a single quarter.
Ouch. And you said earlier this wasn't because they stopped selling rubber, their volume was actually up.
That's what's critical to understand. This wasn't a sales volume collapse. Their natural rubber sales volume increased by over 20% year over year in Q2. The profit disaster wasn't about operations grinding to a halt. It was driven by two huge immediate hits related to pricing and inventory.
Okay, hit number one, the price collapse itself after the US tariff news.
Right. The announcement triggered a rapid drop in global rubber prices, over 20%. Buyers held back. And for STA, this created a severe margin squeeze because the price they could sell at dropped much faster than the cost of the raw rubber they'd already bought or committed to buy. Their input costs were sticky downwards.
And the second hit, that relates directly to their integrated model and the sheer amount of inventory they hold.
Exactly. Because STA is so big and integrated, they naturally hold vast amounts of inventory at every stage: raw materials, work in progress, finished goods. When the market price collapses suddenly like that, accounting rules, specifically IAS 2 on inventories, force you to write down the value of that inventory to its net realizable value, NRV.
Right.
Basically what you could sell it for now.
And that write-down was big.
Huge. FTA had to book an inventory provision, an NRV write-down, of 334.2 million Thai baht.
So nearly half the total loss was just this accounting adjustment on inventory they hadn't even sold yet.
Pretty much. It's a non-cash charge in that moment, but it reflects a real loss in value. That inventory was suddenly worth much less than what they'd paid for it just weeks or months before. It's the downside of being the integrated giant with huge stockpiles when the market turns against you sharply.
It really highlights the difference. NER used financial hedges to cushion the blow. STA's scale and inventory position actually magnified the blow through this accounting rule.
That's a great way to put it. Their scale became a vulnerability in that specific sharp downturn.
So STA's volatility seems almost inherent in their model, right? Especially with that added cyclicality from the glove business. But management is still forecasting a recovery, a V-shaped recovery in the second half of 2025.
They are, and analysts seem to be buying into that narrative too, maintaining buy recommendations.
Is that forecast based on things they are doing differently, or is it more just hoping the external market bounces back?
It seems largely based on external factors normalizing. The expectation is that global demand will pick up, maybe the tariff situation gets clearer, and importantly, that average rubber prices will rise again. Analysts are talking 175, 180 US cents per kilo, maybe by Q3 27. They also mentioned cost efficiencies they're working on.
Okay.
But you're right to be a bit skeptical. That V-shaped recovery heavily relies on the market cooperating. And as Q2 brutally demonstrated, the market doesn't always cooperate. STA is playing a much higher risk, higher reward cyclical game compared to NER's focus on stability.
Okay, so this brings us right back to the fundamental strategic differences and what it means for an investor looking at these two. The data clearly shows STA's results jump around a lot more, while NER seems much more stable quarter to quarter.
Yeah, and we've kind of dissected why. STA's integrated model, their massive scale and inventory. It makes them super sensitive to global price swings. That big 334 million bat inventory write-down is the perfect example. Plus, the glove business adds another layer of cyclicality.
It's like they're a giant ship takes a long time to turn and feels the waves more acutely.
That's a good analogy. Whereas NER, maybe they're more like a speedboat, more nimble.
Focused on just getting the cargo delivered quickly and efficiently.
Exactly. Focused on throughput, managing costs locally, and using those financial tools, the FX gains, the derivative gains like shock absorbers. They're not trying to control everything, just execute flawlessly on their core business and hedge the external risks.
Okay, so given those really stark differences in strategy and recent performance, let's spell out the takeaways. If you're an investor considering these, what kind of profile fits each stock? Let's start with NER. Who is the typical NER investor?
The NER investor, I think, prioritizes stability first and foremost. They want predictability. They see that strong, consistent earnings growth, even in tough times, and they like it. They're drawn to that incredibly low PE ratio, 4.34 times, which screams value based on current performance.
And the income appeal is strong too.
Definitely. That 8.49% dividend yield is very attractive if you're looking for regular cash returns. So stability, current value, high income, that's the NER proposition, the trade-off you accept. A bit more leverage on the balance sheet, that 1.17x DE ratio. You trust their operational and financial management to handle it.
Okay, stability, value, income. Now, contrast that with STA. What kind of investor is drawn to STA, especially after that rough Q2?
The STA investor is playing a different game. They're likely a cyclical opportunist, maybe with a longer time horizon. You're not buying STA for its smooth earnings right now, clearly. You're buying it for the potential rebound that V-shaped recovery analysts talk about.
Banking on the cycle turning back up.
Exactly. And crucially, you're buying it because you believe in the underlying strength of its assets and its balance sheet. You see that low price-to-book value of 0.64x and think, I'm getting these massive integrated assets on sale. And you see that incredibly low debt-to-equity of 0.54x and think, this company has the financial muscle to survive this downturn and thrive when things improve.
So it requires patience.
Yeah.
Willingness to ride out the volatility.
Absolutely. You have to be comfortable with potentially big swings in quarterly earnings like that huge loss we saw. You accept that short-term pain for the potential long-term gain if the rubber and glove markets recover strongly, amplified by SDA's scale. It's a bet on the cycle, underpinned by asset value and financial strength.
Before we conclude, we should definitely touch on ESG and governance. It's increasingly important, and it often ties into that long-term resilience story. How do they stack up here?
Both companies are clearly putting effort into ESG, but maybe with slightly different focuses, which kind of mirrors their business strategies. NER seems strong on the traditional corporate governance metrics and local impact.
Like specific ratings and awards?
Yeah, they highlight things like achieving CAC change agent status, getting top marks, level 5 stars on things like their AGM checklist and the corporate governance report, CGR. Operationally, their ESG focus seems quite tangible and local. They report specific reductions in plastic waste, nearly 47%, and water use intensity, over 21%, just in Q2 compared to their baseline. It feels very grounded, very operational.
Okay, solid local governance and operational ESG. What about STA? Their green rubber leader positioning sounds more global.
I think that's right. STA's ESG narrative seems more geared towards securing that long-term global competitive advantage. The big push on EUDR compliance is key there. They also talk about using AI in manufacturing, collaborating with government research bodies for innovation. It feels more strategic, more focused on future-proofing the business on a global scale.
And they probably link their financial strength to governance too.
They do. Management often highlights that super low DE ratio, 0.54x, and strong liquidity, current ratio 2.56x, almost as a pillar of their governance. It demonstrates prudence, stability, and the financial robustness needed to invest in things like EUDR compliance or weather market storms. It ensures the company's long-term viability.
Interesting. So again, a subtle difference. NER strong on current governance scores and local operational impact. STA governance focused on global compliance, innovation, and underpinned by that fortress balance sheet as proof of long-term stability. #outro. Okay, so as we wrap up this deep dive, the picture becomes incredibly clear, doesn't it? The choice between STA and NER isn't just about picking a stock, it's about picking a philosophy almost. You're choosing between NER's proven stability and immediate rewards, that solid profit, that high dividend yield right now.
Right, the comfort of consistency.
Versus STA's foundational strength, its sheer asset power, and the potential for a really significant cyclical turnaround, all backed by arguably one of the safest balance sheets you'll find in this entire commodity sector.
You get NER on one hand. It navigated a really nasty Q2 storm with, frankly, impressive grace, kept growing volume, used smart hedging to deliver profits when the core market was tough. And that resulted in a PE that just looks incredibly cheap at 4.34x. You can see the appeal immediately.
But then, STA. Yes, they took an absolute beating on the bottom line in Q2. That inventory write-down hurt. But the fact that the company absorbed that hit, again, think $22 million USD equivalent loss, and still ended the quarter with a net debt-to-equity ratio below 0.6x. That speaks volumes about their underlying financial structure, their planning, their resilience.
It really does. And that leads us to the final, maybe provocative thought for you, the listener, to chew on. In a market like natural rubber, defined by boom and bust, by unpredictable shocks like tariffs, where is true safety found? Is it with NER, whose recent success, while impressive, relied significantly on getting complex financial hedges exactly right to smooth out the bumps?
Trusting the financial engineering to continue working.
Or is true long-term safety found with STA, where yes, the quarterly earnings might give you whiplash, but that rock-solid balance sheet provides an enormous cushion, ensuring they have the deep pockets and the staying power to outlast any storm, regardless of what one bad quarter's profit statement says. At the end of the day, are you betting on consistently successful hedging, or are you betting on foundational financial bedrock to carry you through the entire cycle? That's the choice.